Good evening. My name is Richard Kapsch. I'm the Managing Director of Pride Holdings, LLC, based in Schaumburg, Illinois, and today I'm speaking to you from Schaumburg. My experience in the industry for about 45 years, which is probably more than most of you in your entire lives. My experience includes 11 years on the Chicago Mercantile Exchange, 6 of which I was a member of the Board of Governors. I've had a job in just about every possible job in the industry in that 45 years. My education, I have a Bachelor of Arts degree from Yale and an MBA from New York University. Today we're going to discuss, as I said, the foreign exchange markets. We'll talk about some history, why the foreign exchange market developed as it did. And second, we'll talk about the operations of the foreign exchange market. We'll be discussing the interbank market, where 99% of the trading in foreign exchange takes place. And we'll talk, as I said, we'll be talking about the history, how the market developed as it did. And we'll also be talking about spot trading, which is what most of you are probably interested in. Those of you that trade foreign exchange, trade the spot market. The interbank market also trades 2 other types of instruments. They trade forward contracts, where a company can buy or sell a contract for future delivery, similar to futures contracts. And it also trades options, which is probably the fastest growing segment of the interbank market over the last 10 or 20 years. We won't talk about options today, but we have planned to talk about options in a couple of upcoming webinars. As I said, today we're going to concentrate on spot trading. The current foreign exchange market is an outgrowth of a number of meetings held in the Mount Washington Hotel in 1944 in Bretton Woods, New Hampshire. If you remember your history, 1944 was still had the Second World War was raging throughout the world, but at that time in 1944, it looked like Germany, it was pretty certain that Germany and Japan would be defeated. So what happened in 1944, the finance ministers of all the free nations of the world gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire, to design a system that they felt would take the world into the 21st century. They had several objectives in this. First of all, they wanted to make sure they avoided the problems that occurred after the First World War ended. For those of you that are familiar with that history, that war ended in 1918 with Germany and Austria being the losing nations in that thing. And what the winning nations did in World War I is they heaped reparations on Germany. Reparations are something that a losing country pays to the winning country after a war. And these reparations were so onerous that it created all sorts of problems for Germany in the decade that followed the end of the war. First of all, in 1923, in order to pay for these reparations, the government inflated their money supply to the point where we had hyperinflation. We had, by October 1923, a 1 mark note had gone from the minimum currency you could get in Germany to pay for anything was a 5 billion mark note. So whereas we're used to inflation of 1 or 2 or 3% nowadays, at that time we were talking about thousands and thousands of percent inflation. And what happened was people would have to collect their money in the morning and run to the store immediately, because if they took their time, the money would be worthless by that afternoon. And this created a stigma among the German people, a resentment toward the other nations in the world. The other thing that happened as a result of the reparations is we went in 1929, when we went into the Great Depression, and Germany was especially hit hard. And as a result, that was created further resentment among the German people. And as a result of this resentment, it paved the way for Hitler to come to power in 1933. And of course, once Hitler came to power, that led to World War II, which was probably worse than World War I. So what the people designing the system at Bretton Woods in 1944 wanted to avoid was the same type of problems that came out of the First World War. Now, in designing the system, they had two major objectives. One, they wanted to develop a system that would foster economic recovery throughout the world. With the exception of the United States, most countries coming out of the Second World War were destitute. So there had to be some kind of a system that would enable these economies to recover. And then the second objective, once the recovery would take place, they wanted to foster trade among the nations. People felt that trade was very important to growth, and that whatever monetary system they developed would help develop this trade among nations, and therefore also help them recover their economies. Unlike today we've got a president in the United States, Donald Trump, who believes that trade isn't important, but I think most economists would differ with him in this regard. The system that developed under Bretton Woods system, was a fixed rate system, a system of fixed rates, where every currency in the world was tied to the US dollar and at a fixed exchange rate. And these exchange rates were only allowed to fluctuate plus or minus 1%. So if the dollar went up by 5%, every other currency in the world had to go up between 4 and 6%. Now, obviously, this is a far cry from what we've got today, where you might see a plus or minus 1% move within 10 or 20 seconds in the markets. As I said, all the currencies were pegged to the dollar. It means fixed to the US dollar, and were allowed to fluctuate plus or minus 1%. Now, the only currency that was not fixed was the US dollar itself, and there had to be some mechanism to keep the US policymakers honest. So the dollar itself was pegged to gold at a rate of $35 per ounce. And the way this worked is, if countries felt that their inflation, or that they had too many dollars and that it was creating inflation in their countries, they could go to the United States with those dollars and exchange them for an ounce of gold at the rate of $35 an ounce. So this was the way the system was designed to encourage economic recovery and foster trade as the years went on. Now, the key to the system was economic coordination. By having a fixed rate system without it falling apart, every country had to coordinate its own economic policies with that of the United States. And if everybody did this, then the system would function smoothly. Okay, let's take a look at what the experience of the system was. First of all, the first thing that started to create problems for the Bretton Woods system was a resurgence in U.S. inflation. There were just too many dollars in the world. The classic economic definition of inflation is too many dollars chasing too few goods. And what we had in the United States, first of all, in the world, immediately following the Second World War, the countries in Europe that were trying to recover from the war needed currency, so the U.S. developed something called the Marshall Plan and pumped dollars into Europe. And following that, the U.S. companies decided to expand into Europe, and they did so with U.S. dollars. As a result, we had a surge of U.S. dollars in the world economy. Now, something had to be done to counter these U.S. dollars. Unfortunately, it didn't. So as a result, we started to see inflation start to pick up around the world. This got worse in the 60s when Lyndon Johnson was president. The U.S. was fighting the Vietnam War, and at the same time, Johnson was intent on domestic policies in the United States. He had something called the Great Society, and he felt that he could afford to fight the war and at the same time pay for his Great Society, all his domestic programs. The problem is, economists will tell you there's the guns and butters problem. You can have guns, you can have butter, but you can't have guns and butter. But what the U.S. was trying to do by fighting the war was to have guns and pay for its domestic policies by having butter. So they were trying to counter economic truism in this case, and it didn't work. So as a result, we had a lot of dissatisfaction with the U.S. management of the world economic system because of its inflation. So the first thing that happened was the French decided they didn't want dollars anymore, and they decided they would exercise their right to sell those dollars to the United States for gold. Now the U.S. at the time was by far the biggest depository of gold in the world. Most of the gold was kept either at the New York Fed in New York City or at Fort Knox in Kentucky. But as I said, most of the gold was held by the United States. But as the French started to sell dollars and buy gold with it, the U.S. supply of gold started to deplete. And there was a concern that if other countries around the world followed the French lead, that the U.S. would run out of gold. So in 1971, President Nixon at the time decided to close the gold window, meaning that he halted all gold sales for dollars, contrary to the dictates of the Bretton Woods system. And of course, what he said is the Bretton Woods system continued to exist. However, without the gold, without the U.S. dollar being tied to gold, it really wasn't an effective system anymore. And as a result, the strains got greater and greater. And by 1973, it blew completely apart. And what replaced the fixed rate system of Bretton Woods was a system of floating rates, where every exchange rate would vary according to any other exchange rate, according to the laws of supply and demand. And if you realize this is the system that we have today, some 44 years later. But in 1973, we went to a floating rate system, and supposedly, you know, that's the system that we've stayed with since then. Now, the system we have today isn't a purely floating rate system, even though you might think every exchange rate is freely floating. It's not. We have some variations that take place. First of these are called what we call dirty floats. And a dirty float is where the central bank of a country intervenes in the foreign exchange market for its own currency to either buy or sell that currency according to whatever its own economic policies might be. In the 1970s and 80s, Japan was trying to manage its float by keeping a lid on. There was a lot of demand for Japanese yen. The Bank of Japan came in and sold yen in order to prevent the yen from floating upward. Today we have China as being accused of conducting a dirty float with its currency, the yuan. There's a lot of pressure on, particularly in the U.S. government, on China that they're accusing China of manipulating that currency. And this is just another example of a dirty float. A second variation that we have in the foreign exchange markets today that is an exception to the floating rate system are some countries have pegged their rates to the U.S. dollar. One example is the UAE dirham is pegged to the dollar at 3.67 dirhams per U.S. dollar. Generally, what these countries try to do when they tie their rates to the dollar, and the way that they can try to, if people want to sell UAE dirham, they go to the central bank. The central bank will buy those dirham and give them dollars to that regard. But the reason they keep these rates fixed to the U.S. dollar is because they want to copy U.S. monetary policy. In the United States, monetary policy is conducted by the Federal Reserve System, and you know, the U.S. Federal Reserve either raises or lowers interest rates depending on how it feels about the own economy. But one thing it does is it keeps interest rates high enough so that inflation doesn't get out of hand. And what these countries that have pegged their rates to the U.S. dollar do is substitute U.S. monetary policy for their own monetary policy, so that they've tied their worth to the dollar. A third variation of the floating rate system are what we call managed systems. And the biggest example took place in Europe. First, when the system went to a floating rate system in 1973, the major economies or major countries in Europe decided that they still wanted some kind of a fixed rate system. So what they did was they created something called the European snake, where every currency, at the time that Germany was the strongest economy in Europe, every currency that wanted to take part in this particular system would peg their system to the snake and allow it to fluctuate plus or minus 2.5% to where the D-mark is. So if the D-mark goes up 5%, then a currency was, let's say the French franc could either go up between 2.5% or 7.5%. But the primary reason why they wanted to keep fixed rates, a variation of a fixed rate system in Europe, was because of the amount of trade that took place among European countries. So by keeping the currencies relatively fixed to the Deutschmark, one, they got to adopt German economic policy, which they felt was the strongest in the world. And second, they also took advantage of the lack of currency fluctuations when it came to their trade. This system subsequently developed into the European monetary system in the late 80s, and then ultimately in 1999, we saw the replacement of the managed system, the European monetary system, with the European common currency, the euro. So the euro's been around for 18 years, and it was an outgrowth of these managed systems. Okay, let's talk about the interbank market. When we talk about the foreign exchange market, what we're really talking about is the interbank market. The interbank market conducts 98 to 99% of all foreign exchange transactions traded throughout the world. And to give you some background on the interbank market, on a daily basis, approximately $6 trillion worth of foreign exchange is traded in the interbank market. And in the interbank market, there are three major players. First of all, the banks themselves are the biggest players. But however, any customer that wants to buy or sell currency for international trade or any other international transaction has to go to these banks. So they become a participant in the interbank market. And finally, when central banks want to intervene in their own currency, they too go through the interbank market. So these are the three main participants in the interbank market. As far as participation goes, corporate clients trade approximately 5% of the total currency traded in the interbank market, and banks themselves trade 95%. Okay, let's look at the specific trading in the interbank market. As I said earlier, there are three major transactions. Major types of transactions that take place in the interbank market. First of all, we have spot trading. And what spot trading is, when you buy or sell a currency for spot, you're expecting delivery in 2 business days. So we say spot transactions usually take place with a settlement of T+2, where T is the transaction date and +2 is the additional time it takes for these transactions to clear the markets. And as I say, by far the biggest, maybe 90% or 85% of the transactions that take place in the interbank market are trades that are done for spot. The second type of transaction are forward markets, which are specified on some futures date. These are generally used by corporations who want to hedge either imports or exports or future sales, and they'll buy or sell forwards, but this is a relatively minor part of the interbank market. And then third, we have options, which is the fastest growing part of the market, probably 10 to 15% nowadays. And as I said, we're planning to talk about options in a couple of upcoming webinars later on in the next couple months. As far as size of transactions in the interbank market, The minimum transaction size is usually $1 million, which in interbank parlance is called, they'll call it $1, but a minimum size is $1 million. Most of the trading in the interbank is bank to bank, and when banks trade with other banks, it's generally in a size of $5 million. Okay, let's talk about bank trading. Every interbank market, every bank that deals in the interbank market of any consequence has its own dealing room. And this dealing room consists of currency dealers. Those are the main traders of currencies that trade bank to bank and trade for customer representatives or for customers. We've got a number of customer representatives. These are generally salesmen that deal with the bank's customers and pass the trading on to the currency dealers. So those are the two main participants in the dealing room. Now, one important distinction in the dealing room is that of market maker versus market taker. The banks themselves are generally market makers. When they offer a currency for sale or for purchase, they will give you a bid and ask in the market, and they're generally a market maker. Anybody that deals with these banks is a market taker. And we'll talk a little bit about how those work a little bit later. But generally, if you're dealing in the foreign exchange market, let's say through one of the foreign exchange firms, you are going to be a market taker. What you'll see on your screen is the market in any currency, a bid and ask, and that's a market that's being made by some representative of a bank somewhere in the world. And then what you have to do is, if they will give you a bid and ask, you have to sell at the bid and buy at the ask. And one of the ways they make money, in addition to trading for their own account, is by this markup between the bid and ask and when they make markets for customers. So, important distinction. Banks are generally market makers. They make the markets. Customers and clients and traders that aren't in the bank itself are generally market takers. They're at the mercy of whatever bid and ask the banks want to make. Now, one important consideration if you're trading currencies is to understand how the bank traders operate. Generally, what they do is, in the banks, they're not interested in long-term markets. They're generally very short-term. And what they do is react to information flows. Like yesterday, for example, last Friday, not yesterday. On Friday, we had an unemployment report in the United States in which the unemployment, the number of jobs, non-farm payrolls, the number of non-farm jobs created was 235,000. That was a little bit more than expected. Generally, what these bankers would do, once the information came out, they would instantly compare it to what the market was expecting and then, react accordingly. In this case, it was a little bit more than expected, which was a little bit bullish for the dollar because more jobs might lead to higher interest rates. So generally, traders bought the dollar on that news, so they reacted, and they trade short term. They would probably wait for the market to move and immediately get out of there. So their idea of short term is probably even shorter than you as traders trading through one of these systems. They might be in for 5, 10 seconds, or maybe maximum of 30 seconds. The other thing is that traders know what their customers are trying to do and what central banks are trying to do, and they will trade off these customers and central banks. If you did this in the stock market, it's called front running and it's illegal, but it's not illegal in the interbank market. So if a customer comes in with an order to buy euro and sell dollars, and that's any size, the banks might take a position in their own account based on that customer order. The same thing goes for central banks. Okay, let's talk about settlement of spot transaction. We said that by far the largest number of transactions, or the greatest percentage of transactions that take place in the interbank market, are spot transactions. And let's look at how these currencies are settled. First of all, if you're trading a spot and you expect to take delivery or have to make delivery of a spot transaction, the currencies are paid in that currency's country. So if you're buying yen, selling dollars, for example, if you buy the yen, you're going to take delivery of yen in Japan, and you're going to have to pay the dollars in the United States. So each currency is paid in that currency's country. In the case of the euro, you go through the European Central Bank, or have an account in one of the European countries, a euro account in one of those countries. So if you were buying euros, you would take delivery on that particular account in Europe. You'd pay the dollars in the United States. Now, normal settlement is 2 business days. And with electronic developments in the marketplace, they probably don't need it anymore, but this is a convention that's been in place since the foreign exchange market started floating. Generally, it takes 2 business days to clear a spot transaction. The reason being are the time differences from market to market. So, for example, if you're buying yen and selling dollars, by the time you buy that yen and sell dollars in the United States, the market's already closed in Japan, and you have to wait for the next day for the operations people to take care of it. So that adds 1 business day, and then they add 1 more day for settlement. So generally, the reason we have T+2 in spot markets, spot settlements, is to account for the time changes around the world. Now, there are several exceptions to this rule. One of them is the US dollar, Canadian dollar is a 1-day settlement. And the reason being for that is because both currencies are traded in the same time zone. So you don't need that extra day for the operations staff to catch up. So when you buy US dollars, sell Canadian dollars, you can get your delivery the next day. The other exception is the Singapore dollar and the Malaysian ringgit. If you buy before noon on that trading day, either currency, and sell the opposite one, you can take delivery that afternoon because they're so close to each other. Now, holidays affect settlement. In the Europe and the Far East, when there's a holiday, settlement is moved back 1 day. So instead of T+2, it becomes T+3. If the holidays take place in the US or Canada, there is no change. It's still T+2. Okay. Foreign exchange there are 2 conventions of quotations. One is what we call European terms, where the currency is traded in terms of units of foreign currency per dollar. And that's the way it had been generally up until the last 20 or 30 years, with one major exception. So most currencies are traded in European terms, where such as the Japanese yen, number of Japanese yen per dollar, Indian rupees per dollar, even the Chinese yuan or the Russian ruble in terms of dollar. Those are all European terms, or also termed indirect quotes, where they're quoted in units of foreign currency per dollar. The other variation is U.S. terms, where we have just the opposite, where these are direct quotes as opposed to indirect quotes. And these are quoted in dollars per unit of foreign currency. Up until 1999, most currencies were still European terms with the exception of the British pound. And the British pound was always quoted in U.S. terms, in terms of dollars per pound. The reason being that was in deference to Britain's history as being one of the leading economies in the world prior to the First World War. As in addition to the British pound, the Australian dollar and New Zealand dollar were also quoted in U.S. terms, dollars per unit of foreign currency, simply because they were formerly part of, or still are part of, the British Commonwealth. And then, as I said, in 1999, when the euro came into effect, most people thought it was going to be quoted in European terms like the Deutschmark, in terms of numbers of euro per dollar. However, the euro, people running the European Central Bank and the powers that be in Europe decided that they didn't want to kowtow to the dollar, that they wanted their currency quoted in dollars per unit of foreign currency also. So generally, most currencies are traded in European terms, units of foreign currency per dollar. The exceptions to that are generally the British pound, the Australian dollar, New Zealand dollar, and the euro are traded in dollars per unit of currency. European terms are also known as indirect quotes. U.S. terms are direct quotes. Okay, in converting European terms to U.S. terms, it's very simple. One is simply the reciprocal of the other. So the European quote is 1 divided by the U.S. dollar, or 1 U.S. quote, or U.S. term equals 1 divided by the European quote. One is simply the reciprocal of the other. As an example, we've got the dollar Swiss, quoted in European terms, might be 1.5021 Swiss francs per dollar. And in U.S. terms, when you divide 1 by that number, 1 divided by 1.5021, you get 0.6657 per Swiss franc in U.S. terms. So 1 is simply the reciprocal of the other. Simply means you divide 1 by that currency quote to get its reciprocal quote. Okay, let's talk about some terminology in terms of foreign exchange quotations. And let's say, as an example, we've got the U.S. dollar, Swiss franc, USD, CHF is quoted at 1.502530, 502530. If people are talking about points in the currency, the points are determined by the difference between the bid and the ask. So in this case, 50.25 to 50.30 is, the spread is 5 points. If you were calling somebody on the phone to find out what a quote was, you might ask, he might give you a quote of 25.30, but you might be, if you didn't have access to a screen at the time, you might wonder whether it's 49.25.30 or 51.25.30 or what. you might ask him for the big figure. In this case, he would tell you that 50 was the big figure in this currency. Okay, some other quotation conventions. When you get a quote, let's say USD CHF, the first currency in the quote is always known as the unit value currency. And the second currency is known as the pricing currency. So if you're quoting US dollar CHF 150.2530, the second currency is quoted in terms of the dollar. In other words, the number of Swiss francs per $1. So the second currency, the pricing currency, is quoted in terms of 1 unit of the first currency, the unit value currency. Some examples of quotation conventions. Let's say we've got the US dollar, USD JPY, US dollar Japanese yen is quoted at 124.5060. In this case, the bid in that would be 124.50 yen per dollar, because the US dollar is quoted first. It's the unit value currency. The Japanese yen is the pricing currency. So we can say the bid in that particular quote is 124.50 yen per dollar. The ask is 124.60 yen per dollar. It's always the pricing currency in terms of the unit value currency. If we've got the euro US dollar quoted at 0.889295, we would say that the bid is 0.8892 dollars per euro, US dollars per euro. The ask is 0.8895 dollars per euro. So again, everything is, the first currency is always the unit value currency. The second currency is the pricing currency. And the bid and the ask is always quoted in terms of the unit value currency. Now, further elaboration on quotation convention. When a bank trader quotes you a currency, let's say US dollar, Japanese yen, at 124.5060, he is saying that I will buy the unit value currency at the bid price and sell the unit value currency at the ask price. So in this case, US dollar, Japanese yen, 124.5060, the bank trader, who's the market maker, remember, is saying, I will buy dollars at 124.50 yen per dollar. I will sell the unit value currency. I will sell dollars at 124.60. So he's always buying the first currency and selling the first currency in that order, bid ask. Okay, that's basically covers what I was planning to cover in this presentation this morning. I'd like to open, if anybody has any specific questions on anything I talked about. Can we set that up so people can ask questions? Okay, I don't hear anybody asking questions. I'm not sure if we're set up to ask questions, but one thing we can do is we can make this PowerPoint presentation available to anybody who wants a copy. Just talk to your marketing people and they'll be able to send you a set of the PowerPoint slides if you want them. Other than that, that's all I have. So I want to thank everybody for their attention. And we've got another one coming up next week when we're talking about forecasting foreign exchange. Maybe somebody will be there at that time.